our resource person, and also our participants for this today's program. Mrs. Godakanda, the director of the college, and Mr. Vedika, and the coordinator. And I consider it as a privilege to speak to these young professionals who are the future leaders of the banking sector. That is our motto. Our motto is to empower future generation with knowledge and skills. So this group represents one part of it. And today's program is about credit management, advanced credit management. Actually, when I look at the basic qualifications for someone to enroll in this program, you have to have the credit, the foundation understanding about the credit management with professional qualifications. That means the participants here today are equipped with fundamental credit management principles and also experience of around at least 6 years. So you are going to build on the foundation that you have already established theoretically and also practically. The basic question that we have to ask in credit is, why should we manage credit? Because now if you ask the basic question, why should something be managed? We have to manage it because sometimes it does not move the way that we want it to be, and also especially in a project we have some expectations. Sometimes the operations may not go the way that we have expected at the very beginning. Therefore, that has to be continuously managed, monitored, supervised, corrected, and all those things should happen. Now, if we take the Sri Lankan situation today, now as a nation, we are facing a debt problem. Actually, debt problem. Have we created this by ourselves? The simple answer is no. Then what has gone wrong? Actually, there are certain things happen to our cash flow, because now when you borrow, you borrow with a plan to invest and then repay based on the future cash flow you have. But unfortunately, because of this crisis situation, our cash flow has dried. Therefore, in many different ways. That is from the borrower's point of view. If the borrower does not manage the credit, and if the borrower does not give due provisions to the future payment liabilities, if contingent situations arise, then we face problems. That is what has happened to Sri Lankan situation now. It is not something that we have purposely created, but it is beyond our control. The same thing can happen to the projects that we lend. Now, this course is mainly about the lender side. Now, Sri Lanka is facing from the borrower side. Now, when you look at the credit management from the banker's perspectives, we are looking at from the borrowers, there's a lender side. Why should be that much concerned about? Because even though lending is an asset to the bank, that is tied to a liability, because most of the funds that we lend are related to the deposit liabilities that we have collected from the customers. So we are also in the middle. And the other thing is this: when you lend to a project, the investor in the project is also taking a risk, because he also can't see the exact situation with respect to his future cash flows. Certain things that could happen, certain things that he has not expected could happen to his business. Take the hotel industry, tourism industry, all those who are affected. Then the banks who have lent to those, now those industries has been affected by this, and as a result, we are also affected. That's why the credit management is very, very important. And also I saw in the syllabus, we have the follow-up module also. That means we have to make sure after borrowing, we have to make sure that the person is utilizing that credit to the expected, this intended purpose, and also continuously monitoring it to ensure that our repayment plan is effective. So that way, credit management is a very broader area. In the syllabus, I saw that all aspects of assessing credit and also following and also taking risk management, all those things are there. So you are going to have a very comprehensive exposure to the complete area of credit management, and finally you will become advanced professionals in credit management. I think in the banking and financial sector, financial industry, the credit managers are very highly recognized, and also they have a commanding position, especially when it comes to recoveries and all those things. Okay. With that, let me introduce our resource person today. He is one of the senior lecturers, visiting lecturers of the IBSL for a long period, conducting programs under different projects, and also he is a financial engineer turned from a production engineer. His educational qualifications are from production engineering side. Now he has become a financial engineer. So the production engineer turned financial engineer, Mr. Kudagamuge, and he has been working in the National Development Bank for more than 24 years now, a long period of experience. And also he has, for his credit, he has earned a Masters of Financial Economics from the University of Colombo. And he, as I said, he has a Bachelor of Engineering in Production with a first class from India. And also he has exposure by following a course in USA. So he has both a local and international exposure. And in the bank also he has held many positions. Presidents of Staff, that is social work, President of Staff Recreation and Welfare Club, advisory team in re-engineering SME business. And also he has, this is a page 2-3 pages to his credit. I think simply by looking at this, I can say that he is a well-conversant and well-experienced resource person. If I'm going to read all, it will take some time. Mr. Kudagamuge, you allow me to stop here, no? It's okay, no? And
that's fine.
Actually, now you will see during the course. You see how you can see how resourceful he is, and then one request I have to make to our participant is try to get the maximum, because now we are having another 5 resource persons to follow they conduct different modules, and take the maximum out of this well-conversant, highly resourceful resource persons, and raising questions and also exchanging your views, because from our side, we are the trainers. We give you the principles, exposure, and all those things, but you are the people who are going to actually going to do it. Because I think I am not a credit officer and also don't have the experience in the banking sector. But when you give credit, you always have to have a sense to sense whether this is likely to be a bad credit or good credit, bad lending or good lending, because you can sometimes sense. Our resource persons through all these courses will give you that sense, in addition to the theoretical knowledge and also the case studies, practical situation, as well as how to sense. Because this is like a marriage, no? Until you start living you don't know exactly what the person is. Therefore, the credit also, it is an engagement of 2 different parties who don't know each other 100%. So that's why credit becomes a risk. That's why it has to be managed. Okay, with that, and our Mrs. Godakanta will ensure that you will find your requirements from the IBSL site, and this Mr. Menaka is the coordinator. He is the very active link between the resource persons and also the participants, and also among participants. I know how hard they are working and also how friendly they are in conducting these programs. So then we are going to have a very successful program. Only thing I can say is, okay, please try to get the maximum out of it. With that, while wishing you a very successful program, I request you to stay healthy and safe. Thank you.
Thank you, DG. Actually, our Director General gave a very good example and explanation on the credit. What we are facing today is, yes, sometimes we know everything, but we are not practically putting the theory to work. Therefore, we'll face lot of problems in collecting, because we are lending not our money, it is depositors' money, right? So we have a responsibility of returning that. So whenever we give a loan, we have to do a pre-monitoring part, which is prior to giving money, and post-monitoring. So till the time we collect our last cent, we have to monitor the customer. So with that small introduction, I would like to start. And again, as DG said, please ask questions, right? Since I will be putting a presentation, I can't see the chat box properly. So you can just ask a question and stop me. I'm fine. You can stop me at any time and ask questions. I prefer you asking questions, right? Today, basically, we are looking at an overall view, and then we will be doing the credit policy discussion, right? Which is the key and the most important direction to us, the lenders. As DG said, I've been in this industry for 24 years now, and my entire career is towards lending, right? SME banking and corporate banking, and to retail as well, right? So this is practical. So basically the lending policy, what is we will discuss few things today. So this is how the lectures will structure. 3 to 4 lectures will be there from my side. We will discuss the lending policy, credit administration process, then control mechanisms, pricing structures, and CAPM and yield curve models. So we will have different lectures on each of these. Then at the end of the period, we have at the examination, we have basically 2 questions from me. Each question will carry 20 marks. Right? So that is the structure. Today we will discuss. Start with this. Okay, what is this? This part, bungee jumping. And what is this? Can someone tell me which one is risk? Which one is risk? You can type. I can see the chat box now. Okay, it is given risk. Why it is risk? Why this one is risk and this is a tsunami, right? So why is not this risk and why is it is risk? Any idea? Why we say this one is risk? Risk means the damage which can be calculated, right? You know, now in this scenario, if 100 persons jump on this, maybe a lucky 1 or 2 will go up. All of the rest will remain in this world, right? So we can calculate. Yeah, it is 0.1%, 0.001%. So we can quantify the probable damage. So risk should be the damage which can be quantifiable. Right? However, when you get something like this, right? Natural disaster, you can't quantify. Last time we lost how much? 60,000 people. When next time a tsunami comes, we don't know how many people we lose. It is an uncertainty. So we can't say anything. We can't say, okay, 0.5% dies. Right? So think about housing loan. Whenever we are giving housing loans, we know that 1% will go bad. Whenever we are giving a SME loan, we know maybe 3, 4, 5% will go bad. Right? That is the risk. We can count, we can quantify the probable damage. Right? Then it is risk. If you can't quantify, it is not a risk. Right? Risk is the exposure to present and future. Risk is the exposure to present and future losses of profits and or capital. Right? That's what I do. Housing loans, 3%, maybe 1%, maybe 0.5%. Exposure to present and future loss of profits and or capital. It could be due to faulty analysis of the current circumstances or probabilities. That means we have wrongly analyzed the current position. We have wrongly analyzed the person to whom we are giving money. We have wrongly analyzed the project, the cost overruns, right? Ability to run a business. That is current circumstances. Then, or future changes in pestly environment, right? Risk, it could be due to faulty analysis of current circumstances of probabilities. A. B. Future changes in pestly environment. Hope everyone of you knows what is pestly. Pestly is the macro environment, right? Where a business is in. It is the macro. What does pestly stands for? It is political economy, economical, that is the economy itself, right? Social factors, technological and technical factors, legal factors, and environment per se. This is the environment factor. So any changes in political scenarios, right? Look at the political scenario between what is the latest political issue we have in the world geopolitics. What is the latest? It is the Australia, France, and US base. Right now, Australia and China is not in good terms, trade terms. So Chinese industries will have an issue. Why? Their main imports for steel industries from Australia. Right? Australia is not selling. Similarly, Australia's wine industry is in a problem. Why? Their largest buyer is China. Now China is not buying from Australia. See what will happen to us. We are talking about GSP plus. So Europe is pressurizing us. It is political game. Right? They are pressurizing. Because of that, they are threatening us to take out our GSP plus one. So it is a political game. We have today, not today, we have the Human Rights Council. They're talking only about us. Why? These are all politics, nothing else, politics. So we will have issues there. Then economy. Right? Tourism industry has collapsed now. So all projects in our projects in tourism industry will have problems. Right? Even we are open, still if the economy of other countries, like who are our main tourist destinations, Russia, India, Germany. If their economy is bad, they will not have enough money to spend here. Social. That is the biggest problem we have when you are talking about dairy industry. What will happen to the animals after they are old? What can we do? We can't sell. We can't kill. So that is a key problem we have. Technological. What happened to Kodak? Where is Kodak today? We have not changed. Change in technology. They have not adapted. So technological. Legal environment. Our land tax. Land law. So these several laws will affect our businesses. Environment. Pollution. Waste disposal. All those things will have, like, you start a project today, after 1 or 2 years, surrounding area fully residentialized. Then they will go and say it is sound polluting. So we have an issue, right? So this pestly environment, any future changes in the pestly environment will create risk to a business, right? Then risk management is the process of measuring or assessing the actual or potential damage of a particular situation and taking necessary actions to minimize the effect. So risk management is this. Sorry, this one. This is risk management. Assess risk. You have to identify the risk. Then we have to plan for that risk. You can identify different risks. Shortly we will see what are the risks we have. You have to identify, assess, then you have to plan and control. Implement the safeguards, monitor and evaluate. This is a cycle, right? Always it goes round and round. First you identify, you plan for it to accommodate, then implement the safeguards to protect you, and you monitor the accuracy and safeguarding. Then you assess again. So it will go round and round. Then it is called the risk management. Right? It is the process of measuring and assessing actual or potential danger of a particular situation. Think about operation, or think about lending to a trading business. Right? You can take post-dated checks. The risk behind post-dated checks is, will he or she bring a doctored post-dated check to us, which is not trade-related ones. So safeguard you can plan. Each check, you will have similar people. You have to check for check numbers, or you can have limits for identified customers. Those are safeguards. So then you implement it. You check back facility, you have limits. Any single customer, I am taking only 5 million maximum. Each check should not be more than 50,000 rupees. So you can have plan the policies, then implement that, then monitor. Because we fail most of the time because we don't monitor. Right? There are check returns, we don't bother. We can check returns, customers bring more checks, give it to us, we discount and settle the previous areas. So it is evergreening. It is rotating. We don't know whether these are actual checks or not. So that is risk management. Is the process of measuring and assessing the actual low potential danger of a particular situation and taking necessary actions to minimize the effects. We want to minimize. Then financial risk. There are so many risks, but here we are talking about finance institution. So these are the three main risks in finance institution: market risk, trade risk, and operation risk. Since this is advanced credit, we will be mainly discussing about credit risk. But I will take you through what is market risk, what is operation risk as well. Market risk. Any risk relating to interest rate, commodity prices, currency risk, and equity is market risk. What is that? Interest rates. We are locking a facility, long-term lending at a fixed rate. But our main source of money comes from short-term deposits, right? You lend a facility at 8% for 6 years. What happened? Last 2 weeks, we saw rates going up. 3 months, 6 months rates are increasing. Very soon it will cross 7-8%. So our margins are coming down. We tend to have a higher cost of capital than our lending rates. So any risk arising from changes in interest goes under market risk. Then what is commodity price risk? You know what happened to gold market, our pawning industry. Maybe 5 years ago, it collapsed. Like pawning prices went up to 60,000 that time. Then gold prices dropped. Therefore, pawning prices came to 25,000. What happened? Whoever had lend in 50,000 and 60,000 per sovereign had to take a loss. Changes in any risk arising based on the changes in the commodity prices. The easiest example I can give you here is gold. However, in the world market, it can be crude oil, it can be gas, it can be silver, copper, anything. Right? Then the currency risk. See what happened. Forex changes. 1 week ago, even banks bought at 230. Suddenly it kept to 203. What will happen to that amount of dollars we got at 230? If we have not sold it, we have a loss. We can go and borrow from central bank. Today, I borrow central bank money at 200 rupees a dollar. Within a week, if they float, this will jump to 230. So I have to return the money at 230. So any risk arising from fluctuation in currency is market risk. Then equity risk. We go and invest in stock market. When it crashes, what can you do? Think, 2 weeks ago, some stocks were skyrocketing. I'll give you an example from my own experience. Went and invested on Expo Lanka. Almost everyone went and invested in Expo Lanka. Right? I bought it to 160. It went up to 187. And it crashed. Last working day, it was 165, I think. So I have made a loss. So the same thing, banks also go and invest. Finance companies invest. So any changes due to equity investment, losses due to equity investment, that market risk. So any risk created by interest rate, commodity pricing, currency fluctuations and equity is called market risk. Then we go to operation risk. What is operation? Any risk arising from people, processes, procedures, and systems. Right? Any risk arising from people, you and me. Right? Procedures, processes, and systems. Why you and me? After the politicians, we are the biggest thieves in this country, bankers. Think about how much money our own colleagues have robbed from the system. I don't have the figures last year. I stopped keeping account. Earlier, every year, more than 300, 400, like roughly a 500 million rupees robbed by own bankers. Right? So, anything happen, loss due to people activity will be a risk. Even you walk with a 4-inch heel within the office, fell and broke your leg, then it is a risk to the institution. People. Then processors. Due to any procedures, any mistakes we do, it is a risk to the bank. Systems, even hardware, software, any cyber attacks, it is a operation risk. We talk about dual controls. How many times our dual control crashes? It is a operational risk. Wrongly inputting an account number is an operational risk. So any risk coming from these 4 items are operational risk. Then we'll go to our main topic, credit risk. What is credit risk? Credit risk is, will I get my money back? That is credit risk. Whenever depositor comes and give money to the bank, depositor face the credit risk. Will the bank return my money as agreed? Right? Whenever we lend to a customer, we face the credit risk. Will this customer repay me? Look at what happened to Golden Key. Up to today, there are people whose deposit was not paid back by the government. Swarna Mahal Finance, all depositors, Sakwiti. Money has been given, it was not returned as agreed. Will I get my money back in very, very layman terms? This credit risk due to an uncertainty in counterparties, that's the borrowers or the other parties, ability to meet its obligations in accordance with agreed upon terms. Risk due to an uncertainty in counterparties' ability to meet its obligations in accordance with agreed upon terms. Right? That is credit risk. Credit risk can be divided into 2 parts, which is credit default risk or transaction risk and concentration risk. First, we'll look at what is transaction risk. If we think our borrower, like this case when I am talking about borrower, it is our loan customer. Unlikely to pay its obligations in full, or obligo is more than 90 days past due. That means if we think that customer will not pay us, or actually they are 90 days overdue, that means NPA. If a customer delays his payment 1 or 2 days, that is not credit risk. There are customers who does not honor the due date, but they will pay after a week, 2 weeks, 1 week, 1 month, but they pay. So that is not credit risk. That is a liquidity risk. That is a liquidity risk. The money due to us is getting delayed. That is liquidity. So we have cash flow issues. But if a customer goes more than 90 days non-performing, then it is credit risk. When the bank thinks the borrower will not pay or will not meet his obligations in full, then it is a credit risk. That means I will not get my money. Earlier, I will get my money, but it will take little time. When the customer is in NPL, I will not get my money. You may be going for forcible action or legal action. Or you have to spend more money to get your own money. So that is transaction risk or default risk. Then the other part of credit risk is concentration risk. What is concentration risk? In definition terms, single exposure or group of exposures with the potential to produce large enough loss to threaten a bank's cooperation, right? Single or group of exposures with the potential to produce large enough loss. If it goes bad, it will create a big loss to the bank. So the bank's core business will be in jeopardy. Right? What is it? Think about, there may be branch managers here. Right? Think about your branch. You have a 1 billion portfolio. Out of this 1 billion, maybe around 400 million is with 3-4 customers. What will happen to you? Even otherwise, if they leave you or if they go bad, you have a problem. Because it is large enough to threat your business, branch business. If a customer of 500,000 even does not appear for few months, you don't bother. But if that 100 million guy delay by 1 day, your seat get heated. Right? That is concentration. It is called name concentration. Right? Single name concentration. Then it can be group of exposures. Like you have several people, like a group. Right? Group, like I have few companies grouped together, you have an issue. It is not single entity, but it is a group of companies or group of people. Right? So it is name concentration. Then you have sector concentration. That is, think about Nigambu branch, 3 billion portfolio. Out of that, 1.5 billion to tourism industry. Appeal into moratorium. No money coming into the branch now. That's the problem. Think about a branch where you have lot of more than 50% of your business comes from import business, trade, import trade, right? Today you don't have dollars to give to importers. Your entire business collapse. What will happen to the branch? So that is called concentration. Single low group of exposures with the potential to produce large enough loss to threaten a bank's cooperation. Name concentration is few people or few groups or few companies holding major portion of your portfolio. Then sector concentration is different sectors. You are exposed to few large sectors. Right? Right. Before that. Okay. Can I know? Is it okay? Do you have any questions? Or is my face okay? Can you clearly understand? Anything you want me to change?
Hello, sir. Can you hear me?
Yes, I can hear you.
Hello.
Yes, I can hear you.
Yeah. I have a question on something, sir. That is, I have seen that in certain annual report under the credit risk, they are talking about the settlement risk as well. Can you explain something about that settlement risk?
They talk about settlement risk whenever you have that part of the obligation risk there, right? Transaction risk. When you have LCs, right? Mainly LC part comes under settlement, right? LC settlements, you have export orders where LCs has come in and you are looking at settlement from the other institutions, right? Transaction purely speaks about the customers' transactions. Okay? There's a basic explanation to your question. Is it okay with you? Clear? Not clear? You can text me. I'm looking at the text box as well.
Mr. Kudagamage,
Yes.
is country risk comes under credit risk?
No, country risk is different. That is for the, if you are talking at the point of country level, country risk comes as a credit. It is a credit risk because credit rating is the credit worthiness of a country. Now today, you know, we have been downgraded to CCC. Right? What is a credit rating? Credit rating is the credit worthiness of a country or institution or a person. Right? So country risk is on credit worthiness. So we are at CCC now. Earlier we were at BB minus, Fitch rating. Right? Here we are talking about the customers from the institution's point of view. But when the country risk goes up, right, when the country risk deteriorate, our borrowing cost increases. Why? All of us, we operate on the basis risk-return trade-off. Higher the risk, higher the return, right? So when our country ratings are going down, our lenders, our borrowing lenders will increase their lending rates. Like what you do when you are lending to Micro, you charge a higher rate. Why? You know, micro is, you presume that micro is, Lasanti, just hold on, I will answer you. Micro is high risk. Therefore, we are charging a higher rate. Whenever you are giving a TOD, you charge a higher rate. Why? It is risky. Similarly, when the country risk goes down, increases, our lending, borrowing cost will increase. It is good for the country and same to the institutions. Further, we are embedded in the political structure. Right? We are part of the political structure. When the country risk goes down, our ratings also goes down. Did I answer you?
Yes, sir. Clear.
Okay. So, single borrow limits goes hand in hand with the concentration risk of the bank. Could you explain a bit more on the CBS calculation? Yeah. Like in order to avoid the concentration risk, only CBSL has given this single borrower limit calculation. If I can remember correct, it is 25% of our capital base. That is the maximum. For a group, it is 33%. There's another small calculation based on their external rating and our capital. We can go up to 33 and 36%. So anyway, this single borrower limit is placed in order to restrict the bank on the concentration risk. Right? I have to give you the exact figures. My memory says it is 25% of your capital base for a single borrower. If it is group of companies, it is 33%. And there is another calculation where you can go up to 36%. Lasanti, did I answer you? That was not the answer you were expecting? Lasanti? Okay, right. I misunderstood your NP. Right. Anyone else? Okay, if no questions, I will proceed further. Right. On the financial institution risk structure, we have the board. Then we have two most important board committees, subcommittees, which is the board risk committee and board audit committee. These two committees need to be chaired by independent and non-executive directors. What do you mean by independent and what do you mean by non-executive? Non-executive is bank is not paying. Our CEO is a executive director. He is responsible on the performance of the bank. A salary is being paid to an executive director. Non-executive, they are not paid a salary, just the remuneration, whatever given on a board meeting by board meeting. Right? Independent is you are not a director because you have shares. You have been nominated by central bank or some independent body, right? You don't have a vested interest to see that this company shows profits. Why these two committees are more important? This is the police and the CID, right? Risk committee looks at the risk of the bank, and audit committee looks at the whether we are following the processes properly. So these two are the most important committees, and who looks at the credit risk or the business risk of the bank, and they have to be headed by independent and non-executive directors. Under the board risk committee, we have credit committee, ALCO, asset and liability committee, and operation risk committee. Credit committee looks at the credit risk, ALCO looks at the market risk, operation risk committee looks at the operation risk, the three risks I discussed earlier, right? Then when it comes to risk, these are the four ways we tackle risk. Risk we avoid. We don't take that kind of a risk. We don't accept facilities for some clients. We avoid. Then we accept. Yes, we know there is a risk, but it is good to accept that. We give a facility. Then we try to reduce the risk. How do you reduce? You give a structured facility, you take a mortgage, you take some sort of security, then you try to reduce the risk, right? For short term, you structure your facility to be self-liquidating. That means you always give a working capital facility purely based on purchase orders. Or you can say, okay, if you have supplied something, you can give an invoice discounting, right? POD is a open-ended funding method where you don't know the end use. But if you give a facility backed by post-dated checks, it is a liquidated, self-liquidating. If you discount the invoice, it is again self-liquidating. If you give a trade facility, you know that money went for importation or trade-related thing, right? So that is reduction methods. Then come to transfer. In Sri Lanka, we have very limited risk transfer methods. The only example what we can give is insurance. You take a fire insurance, you take a burglary insurance, you take a life insurance. That is to transfer the risk arising from those events. But in the world, we have derivatives where you can tackle or you can transfer the rate fluctuations or defaults. So differently you can do in the world, but in Sri Lanka we don't have those kind of things. But the only example I can give you is a insurance. So always risk will be tackled through avoid, acceptance, reduce, and transfer. Right? So primary functions of a bank are twofold: lending and deposit mobilization. These are the two key functions of a bank. Lending, I don't need to tell you. Deposit mobilization, why? This is how a bank is being financed. You take any bank. You have TMD, term deposit, fixed deposit, commonly known as fixed deposits. Major portion of your funding is from fixed deposits. Then you have CASA, current and savings account. This may be short term, this may be long term. This is very short term. Then you can borrow from money market, right? Then banks can go and borrow long-term borrowings. Long-term borrowing. Then only we have our own capital, right? Our own shareholders' funds. So all these are liabilities. All these are liabilities. We have to return the deposits. We have to return the deposits. We have to return the borrowings we take short term, borrowing we take long term. So it is very important to avoid the credit risk, because credit risk is the largest single risk bank will have, because it deals with money. We are the custodian of these people's money, so we have to return. So any mistake happens in the credit, these people will get affected. You can go to your shareholder and tell, we can't pay you dividends, there was a mistake and we got a loss. But you can't go to the other people, FD holders, CASA, short-term borrowings and long-term borrowings, you can't go and tell that we got a loss. Whether you make loss or profit, you have to pay them, right? So that is the requirement for credit risk. Deposit mobilization, again, as a banker, we should know that money kept in houses or temples, no use, right? Religious places, we have lot of money just lying. Even in our houses, look at how much money we have. We have till, right? So we put all our coins there. That's it. It won't come to the economic system. As long as you don't bring that money into the banking system, it will not go to the economy. So deposit mobilization is a key function of the bank. So granting of loans and deposit mobilization are the key functions of a bank. However, larger banks are coming out of this lending dependency. Lending gives the fee, net interest income to the bank. But larger banks are moving away from lending. Instead, they go for trade business. They go for fee-related businesses. So there it is coming down than smaller banks. Then we have corporate lending and retail lending. Corporate lending is to lend for the larger ticket size, whereas retail lending is for the consumption purpose, smaller ticket size. Right? Types of banks, we have two types of banks, wholesale and retail bank. Right? Wholesale bank is a bank where we look at the business angle. We mainly work for businesses. We give larger loans. We give trade finance, project finance, all relating to businesses. Like earlier, NDB was a development bank. DFCC was a development bank. But other banks started as retail banks. Retail banks are the banks who are looking at the individual requirements, consumption lending. This is the normal scenario of classification of bank. However, like corporate or the wholesale banks are doing, in Sri Lanka we don't have a wholesale bank now, or development bank we don't have. Even retail banks are looking at businesses and wholesale banks are looking at retail side. So it is a combination now, but this is the world standard in classification. So we are not the only lender in the market. Borrowers can borrow from different mechanisms. Capital markets, insurance companies, venture capital, alternate sources. I have just mentioned it here, finance companies, alternate sources, but there are a lot of disruption from fintech companies now. Right? It is not only finance companies. We have a lot of fintechs, online lenders who will lend even without meeting you. But there are ways of, earlier, bankers were the gods. If we don't give, they don't have option of getting money. But today, there are other options. If you don't give, there are other ways of raising money. Again, our industry has been deregularized. New innovations comes in. And even the people, the borrowers are more knowledgeable. Right? They are more knowledgeable. They know about the sources they have. So we have to be very careful and we have to be thorough in the market situation. However, some type of lending, those other people can't lend for a project. Cash flow based lending, they can't do. They can do cash flow based lending for short term, right? You will learn different type of lending later from other lecturers. Like you have cash flow based lending, you have asset based lending, like that. You have different lending types. So cash flow based lending, banks are the experts, right? Project finance, based on the future projected cash flows, right? So still you have a job, and again loans are becoming very standardized. It is going, we are moving towards rule-based lending, scorecard-based lending, personal loans, gold loans, credit cards, leasing, all are rule-based lending now. So anyone can lend on those things. As I said, disruption from fintech companies. You heard about Cashwagon. There are so many lenders online now. I recently saw something called Loan Me. Right? So those are smaller fintech companies coming up to our space. We don't have a monopoly now. There are other people. Fintech companies are, because they have a lot of data, they can bypass us, but still we have other expertise. Credit process. So defense lines. We have 3 defense lines before we get a hit. You and me, we are the front line, business operation. We see the risk first. So we are the first line of defense. Then we have risk function, which is the second line. They will, with us, they will be in the credit review division. We have risk team who will work jointly with the business line to put lending into perspective. Similarly, you have post-mortem as well. You have LRM, loan review mechanism, which is a direct nail on your head, right? That is to identify mistakes done by the approvers. So first line is we, you and me, that is the business side. Then second line is the risk side, who will be jointly or who will be directing us on lending. Then they do a post-mortem as well, that is the LRM, CRD and LRM. Then internal audit. they are the watchdogs. If anything goes bad, they have to catch. If they also don't catch, it will come directly to the bank. So this is the three lines of defense: business, risk control, and internal audit. 3I policy. So all these 3 I's has to be bypassed if a trade to get hit. Then credit policy. What is the credit policy? This is our main topic today. Formalize high-level lending guideline. Bank need to follow in granting credit. That is basically credit policy is the overall direction given to us. Right? It is actually that is the invisible hand which controls the operation of the bank. Credit policy. Then credit culture. The fundamental principles that drive lending activity. How management analyze risk and the way the credit is structured. So you and me, we have a culture inbuilt. Right? We know the processes, how we should behave. That is our culture. Similarly, credit also, we have a culture. Different banks will have different trade cultures. Those are fundamental principles and driving lending activity. How the lending is being viewed. How the management think about the lending. Management philosophy that determines how much risk the bank will take and in what form. This is increasingly become the part of overall risk strategy of the bank. That's the risk credit philosophy. Credit culture is fundamental principles that drive lending activity, revolving around how management operationalize credit process. So we have basically 4 credit cultures: value-driven, current profit-driven, market share-driven, and target-driven. What is value-driven credit culture? Under this, what we have is no NPAs. Right? We are looking at only the best customers in the market. Think about Citibank Colombo. Are they lending to you and me? No. Are they lending to smaller businesses? No. They cater only to the international companies here or top corporates in the country. Why? They don't want any hiccups. They don't want any credit risk. So their main focus is into credit quality. Right? 0.001% NPL. When the credit quality is very high, their margins also low. But quality margins. So when your management thinks we need pure good credit, then it is a value-driven culture. Then look at the second one, current profit-driven. What do you mean by current profit-driven? We are looking at short-term profitability. In this kind of scenarios, we will look at credit cards, ODs, short-term lending, clean facilities, because higher the risk, higher the return. So we want to get high return in a shorter period. You take a risk to earn profits. Your focus is to get profits. Management thinking based on profitability. Main decision factor is profitability. Then the market share. Management want everyone to be your customer. So you want the market share to be increased. It is good and bad both. When your market share increases, your volumes increases. Concentration risk comes down. Then target driven, that is to boost your P&L and balance sheet. Grow the assets and the liabilities. Right? Today I am at 500 billion. I want to be a trillion in 2 years. Our aim is to go to trillion. Not the profitability, not the quality. It is a trillion mark. Right? So that is target driven. So these are the cultures we have. You think about your own organization. Sometimes some CEOs, they are very strict on lending. They want pure quality, zero NPLs. Right? Some CEOs, they want to show profitability. They talk about profitability. Then the way everyone will work is different. Then some CEOs, they want to boost the balance sheet. So everyone will run towards increasing the balance sheet. So it is a target driven. Alright? We always have conflict between risk department and the business line. We bring good business, but risk says no. Why? They have given upper hand to control the quality. By the value-driven culture, they are very high-handed. If it is current profit or target-driven, business line will have a larger say. What consists of credit culture? Organization design. Think about the organization where the ultimate, if you are into value-driven or conservative culture, risk department will be a joint approver, or they are the final approver. If you are not looking at that much on value-driven, risk will be providing only their inputs, but the business lines can proceed without listening to risk. Reporting arrangements among loan officers, communication practices, like sometimes on your words, others will work. But if you want to restrict everything, say, okay, no, you need this approval physically, otherwise nothing will move. Incentive schemes for loan officers. Okay, you do a facility, you will get 1,000 rupees paid. So intensify. Why? You know, you need large amount of loans going out. Target and sales orientation. You have a sales team running, your key KPI is target achievement. So it indicates your credit culture. Development orientation, project-based funding. Aggressive versus passive. We need 20% of personal loan market within 2 years. Passive, we ride the wave. Right? we react basically. Right? So these are the areas covered under credit culture. Culture is reflected some of the following ways. Quality management, how strict is the risk department, how tough is the LRM. Then we go for centralized versus decentralized policies. If you are into value driven, we tend to go for centralized culture. Why? Centralized processes, then everything can be controlled very easily. Decentralized, there is an element of human aspect. Centralized, there is no human aspect. Everything, because when the branch manager has a delegation, he faces the customer. Then he is pressurized from the customer. On that pressure, they can take a wrong decision. But you take out the delegation from the branch manager and keep it centrally. Customer touch point and the approver will be different. So they don't bother about the customer. They will go by the rule. Effort to diverse risk and avoid over concentration in particular segment. That is the concentration risk. So centrally we monitor the risk, concentration risk. It is very important, and based on that we can say don't lend short term, lend long term, don't lend this product, lend that product. We can give MIS on that. Delegation of authority, you can pass the delegation to lower levels or you can hold it at the center level. Loan making, marketing and credit function separation. Right? All people who will bring, there will be people who are bringing credit, but they don't have any say on approval. Right? Sales and the credit function separately. As I told, credit quality concern goes to KPIs. If NPL is more than this, you are getting 0 under KPIs. Right? Target as well as quality concerns. Right. Before going there, I would like to answer any questions if you have. Any questions? Any questions from credit culture? Okay, if no questions, we will look at these things. What is credit policy? Who propose, approve, underlying basis, areas to cover. All these things we will discuss now. We will first look at the credit process in a graphical form. Right? If it is a timeline, this is the credit process. So we have loan origination. Loan origination is there. Then we go to evaluation. Then we go to approval. Then we have the loan perfection. What do you mean by loan perfection? It is the offer letters and security perfections. Right? then we go for disbursement, then reviews, then regular recovery. If we fail there, we go for remedial management. From this point to regular recoveries, it is the credit admin function, right? So prior to approval, it is pre-monitoring. After approval, it is post-monitoring. From the day you get to a first inquiry till the day you get to a last cent collected, you have different documentation that is called credit documentation. From review to remedial management, this period they have a traffic light. That means customers will show us that they are going to NPL or arrears beforehand, right? But we conveniently ignore those things. That is called early warning signals. A regular customer suddenly stop returning your calls. It is a early warning signal. Continuous check returns, it is a early warning signal. Continuous request for check purchases, early warning signal. Continuous stop payments, early warning signal. Business management changes frequently, auditors changes frequently, early warning signal. Rapid change in the sales, high increase or decrease, both are early warning signals, right? Because it may lead to over trading, right? Owner and the manager has different opinions always. It is an early warning signal. Owner's wealth increases. It is early warning signal, right? We have to look at these things practically. Anyway, all customers, they show us they are going to NPL before they actually go to NPL, right? Credit admin function looks after from the offer letters to system related issues. Everything covers under credit admin. We will look at that part separately, right? Then, sorry. Again, is another graphical from origination, pre-evaluation, negotiation and approval. Then documentation, closing. This is the CAU part, portfolio management, covenant monitoring, payment, compliance monitoring. Then payment according to terms, repayment goes there. Actual impending default, workout, remedial and foreclosure, right? So this is the credit process. Again, tabulated in this way. You can just go through it. Business development and credit analysis, credit execution and administration, and credit review. So this is the credit process. What is the credit policy? Formalize high-level lending guidelines that the bank need to follow in granting credit. Right? It is the high-level guideline given to credit people. It's a high-level guideline given to the risk people. How to navigate, how to grant credit. And it can be the direction given to lending function. Who propose it and who should approve it? Basically, management, we can propose it, right? But it is the board of directors who owns it. It is the board of directors. So board of directors need to approve. Why? This is the top level direction given to the bank where to go. What is the risk appetite? Right? How much to lend, when to lend, how to lend, all things are given under this. So this has to be approved by board of directors. If something goes wrong, board of directors will be responsible first. If there is a big failure in collection, it is the board responsibility first. As per the central bank, board is responsible for the guidelines, right? It is the board of directors. Who owns the credit? Yes, it is the board of directors, but the custodian of the credit policy is the risk department. Risk department needs to work out the credit policy, but they should never do it alone. If risk department does the credit policy alone, we will never be able to lend, because their aim is to zero NPL, whereas in general life it is not practical. So risk department should take the consultation of the business lines and all other stakeholders when proposing the credit policy to the board, right? So actual owner of the credit policy is the board of directors, but the custodian who produce it is the risk department, right? But they should never formulate alone. It should be a mix with business strategy, because our business strategy is to grow. If risk does it separately, those two are different ways. What should be the underlying basis for creation of credit policy? Right. We'll have a break for around 15 minutes. What should be the underlying basis for creation, revision of credit policy? Right? Factors influencing the credit policy. Capital position of the bank. Capital position of the bank. Why is it necessary? Because right? See, Basel. Under Basel, now we are on Basel 3. We need to allocate capital for each and every loan we grant, right? So if you don't have capital, you can't lend, right? Therefore, you will have to be strict in lending. So if you have enough and adequate capital, you can freely lend. So the capital availability of the bank, so that means this portion, right? Based on the capital availability, your credit policy changes, right? Capital position of the bank. Position of local and national economy. When the economy is collapsing or when the economy is not good, bank also will have to strict on their lending policies. Think about, like when our economy was doing very well, we used to give TODs. We used to accommodate a lot of temporary requirements. But now we are not sure about it. So we have curtailed the excesses, curtailed the TODs. Right? Based on the national or local economic situation, bank will have to adjust. How are we adjusting? We adjust it from the credit policy. Credit policy will say no, limit the TODs, limit to this sector. right? Then competitive position. Like we have several banks in the market. If think about this, my competitors are lending to agriculture. Can I not lend to agriculture? You can't, right? You can't. You will also have to lend to agriculture. My competitors are lending lower rate. Can you go and offer higher rate? No, you can't. Right? So, like that, competitive position of the bank is also a deciding factor for the credit policy. Then the credit culture. Credit policy is a reflection of credit culture. If we are going for profit-driven culture, credit policy will be more lenient. If you are going for portfolio quality value-driven culture, you will have a stringent credit policy, right? Yeah, NPL will have to be 0.01%. If it is credit value-driven, you will have KPIs on NPL management. Your approving authority would be mainly with credit committees or the central people or the risk department. But if you are going for profit-driven or target-driven, you will give approving authority to low end as well because you want to disperse faster. Otherwise, you can't do that. Earning requirement. If you want profitability, if you want earnings, you can't stick to a credit policy. If you have a strict credit policy with a very good high earning target, it is not possible. Higher the risk, higher the return. You will have to look at lending with some sort of calculated risk. So credit card, short-term loans, TODs, those things will have to give. Therefore, earning requirement also play a role in credit policy decision. Deposit variability, right? If you don't have long-term deposits or sticky deposits, lending long-term would be a disaster, right? Therefore, deposit variability is a key factor in deciding are we going for short-term lending or are we going for long-term lending, right? If you have a lot of minor deposits and long-term deposits, you can go for longer period lending. Credit need of the operational area. You are operating in Anuradhapura Polonnaruwa. Can you stay without lending for paddy? No, you can't. You will have to. Because the main area needs is paddy cultivation or agriculture purpose. So your bank will have to lend to that. Then credit policy should be aligned for that. Legal and regulatory requirements. Time to time, we will get different regulatory requirements from central bank. But what do you have now? 10% of your loan book has to be agriculture. 10% of your loan book has to be SME. Year on year, SME growth should be 20%. Those are requirements from the regulator. So your policy should in line with that. Then the monetary policy of the country. We saw policy rate changes, so therefore we had to change our lending, right? Monetary policy. So these are the factors which influence the credit policy. Capital position of the bank, position of the local and national economy, competitive position, credit culture, earning requirement, deposit variability, credit need of the operational area. Like you are in Beruwala, you don't lend to fishing boats. You are in Ratnapura, you don't lend to gems and tea. So it is not practical. You can't. Your credit policy has to align to that. Right? Then minimum elements in the credit policy as per Cbsa. So this credit policy, this policy documents should have target market, risk acceptance, credit approving authority. What is our target market? What is the risk acceptance policies? Approved authority, approval authorities. Those things has to be perfectly given in writing. Then you need to have proactive credit risk management practices like annual or biannual reviews, industrial studies, single borrower reviews, how to visit a customer, when to visit a customer, what kind of documents you need to take. Those kind of risk management practices will be directed through credit policy. Establish and maintain appropriate risk limit and risk management procedures, sector limits, individual limits. Though CBSL has given 25%, you can have a lower limit. Different segments, you can have your own limits. Right? Different products, you can have your own limits based on the risk appetite you have. Delegation of lending. Does the lending approval remains with the credit committee, or have you given delegation to lower levels, right? Branch manager onward, are we giving delegation to branch credit, or is it only with the regional manager, or is it only with the zonal managers, or is it only from the head office, like the delegation of lending? Then requirement for every obligor and the facility to be assigned a risk rating. What is a risk rating? It is the credit worthiness. We have two types of risk ratings: external risk ratings and internal risk ratings. Right? We have to see each and every borrowing customers, whether it is wholesale banking or retail banking, each and every borrowing customer should be rated, right? That means we should know the credit worthiness of this customer. So we look at, when we are doing a credit rating, we need to look at the financial position as well as quantitative details as well in order to create a risk rating system. Risk ratings are twofold: external ratings and internal rating. External ratings are rating agency based ratings, and internal is our own risk model. This should not be developed by the business line. It should be developed by the risk department. It should be tested and monitored by the risk department. Developed, tested, and monitored by the risk department. Business line can only operate the system. They can't do any changes to the system. Then consistent standard for origination, documentation, and maintenance of for extension of credit. That means when you are originating a customer, what kind of documents, minimum documents you need to have. What is the minimum document of information you need? Then what kind of loan processing document? Then what kind of legal documents? Disbursement related documents, monitoring related documents. Everything will be lined up there. Then consistent approach towards early problem recovery. So up to now, what we discussed is from the origination to loan disbursement. Step by step, everything covered under the credit policy, right? Why it is the top level, high level lending direction. Similarly, you have to look at the recovery part as well. So you need to have a proper problem recognition mechanism, early warning system, how to look at first bucket customers, how to look at the second bucket customers, what kind of meetings, what frequently meeting, how to watch list, how to put it to NPL, classification, all those things, how to do a reschedulement or restructuring. All those things has to be given under this. Then the credit limits, obligos, single borrowers, concentration, industry, area. It depends. Like in our country, we don't have much bigger area. But when you talk about a bigger bank, they will have different. Okay, Asian region, we are lending only this much. Right? Southeast Asia, this much. Like that. But in Sri Lanka also, we can have geographical location. Right? Okay, under wet zone, we are lending only this much. Dry zone, this much. This is the concentration. Right? Then other thing is MIS. Right? Without proper MIS, credit policy can't be monitored and follow up. Credit function needs to provide proper MIS to the system. Right? As example, you want to find out what is the exposure to Ukraine when there is a election, there can be anything happen. So we need to find out. So that information should be easily available. If it takes 3 months to identify the information, no point having it. So risk should be able to give the required, credit should be able to give the required information, right? These are the minimum elements central bank is looking at our credit policy, right? I'll show you a policy document. I have uploaded this. These are the different headings of a policy document, right? It covers everything. Target market, exposure limits, collateral, what to take and what not to, risk rating of borrowers, risk-based pricing, delegation of authority, credit process, right? Limit, tenor, clauses and covenants, handling inquiries, marketing, bank service and products. So all these things are given. So again, corporate banking department, branch banking department, cash management unit, different unit also can be classified. So this is a actual credit policy document where main topics are listed, right? So you can just have a look at that. So this is the minimum. Okay, will there be exceptions allowed and how and by whom? Exceptions are consideration beyond the demarcated policy framework. We have a policy framework. If you want to do an exception to that, you can do it. But it needs to be approved by the same people who approved the policy guideline. So that means all the exceptions should be approved by the board of directors, right? However, there are some no exception items as well, like lending to pornography, lending to drug trafficking, lending to arm deals. In Sri Lanka, these are strictly prohibited, right? So these are no exceptions policies, right? There can be a deviation. You need to get the approval from the board of directors for that, but these are no-go exceptions. Policies can be structured. As I showed you, this credit policy can be structured. We should have an overall policy. Then we can have department policy. Within the department, we can have product-wise, right? So you have a big umbrella. Within the big umbrella, you will have different SME, branches, retail, then wholesale banking, cash management, like segment-wise. Then within each, you can have trade business, you can have credit cards, you can have SME, like that. You can have product-wise. So you have an overreaching umbrella, then you have segment umbrellas, then you can have product umbrellas, right? Right. So this is what we saw earlier. This is our credit process, right? This is our credit policy. This is the credit overreaching policy, right? So entire process, credit process, is under the view, under the direction of credit policy. This one. So you have segments: retail, corporate, SME. Within that you have products: term loans, trade finance, credit cards, like products. So you need to have an overreaching umbrella, which is the overall credit policy. Within that, it can be structured segments: SME, corporate, retail, cash management, treasury, like that. Then within that, you can have smaller product umbrellas, right? Anyway, this covers the entire spectrum of credit, from loan origination to final remedial management. That is, from the loan origination till we get our last money in. Everything is directed through credit policy. How to originate, how to evaluate, how to approve, how to perfect the documentation, disbursement, review, recovery, provisioning, everything is given there. What are the EWS, what are the documentation need, pre-monitoring, post-monitoring, function of the CAU, everything has to be given by the credit policy. Why credit policy is an important document? Because it can be realized in the operational efficiency of the credit department. It gives you the loan origination, granting, getting new customers, how to originate, how to grant. All these things are perfectly written, right? Improve the internal communication. Everyone knows their part, right? So I know what to do. My colleague who is doing something else, he knows his, like risk department will know what their job is. Within the risk department, they will have different functions. They will know what their function. I will know my credit process function. Then marketing will know their function. So marketing will not come and tell credit how to do credit, and credit will not go and tell the marketing how to do marketing. So we have clear demarcation on our operation. set out the steps that need to take, mitigate risk and minimize the losses to profit. Set out the steps that need to take in mitigate risk. Risk management policies. What kind of security we need to take, what kind of governance we need to take, all those things given. Then set out the authority levels, DLAs. So everyone knows, okay, this amount has to go to this person, this amount has to go to this credit committee. So it improves the efficiency, include the commercial cycle from getting the lead to putting the money. That's what I told. From the origination to collecting the last rupee. Loan review, monitoring, portfolio management requirement. Loan review, I told you, annual reviews you need to do. Then further to annual reviews, we have CRD. Let me go back to this place. We have another 2 actions here. This one. I forgot to draw that basically. This is CRD, credit review. This is called LRM. Right? CRD is part of the risk department, but they are with the business line. They assist the business line to get the credit into perspective. When we go and say we want to give a 8 years loan, they will come and say don't give 8 years, give 5 years, he can repay. When we go to give a POD, they will come and say don't give entire POD, give 50% POD, 50% short-term revolving because their cash flow is such that. So they will try to put the credit into perspective, that is prior to approval. So they can be approval or they can be part of joint approval or they can just give the guidelines. So it is based on the credit culture you are playing. You can decide whether they are approving authority or they are just the observer, right? So it is just to put the credit into perspective. However, after the disbursement, within the risk department, you have LRM, loan review mechanism. Right? So within risk department, you have this LRM, right? Loan review mechanism. There what happens is, their mandate is to review 40% of the loans granted within 3 months period, but above any given threshold, 100% they will have to check. They will check for any trends, any mistake done by the approver, like that. It is basically a post-mortem to the approver. They report directly to the board credit committee. So they go and board risk committee, they go and report there, right? So it is a hit to the approvers. So approvers are very careful about the LRM, right? Loan review, earlier one was credit review. Then finally, it will set out the provisioning policy. Like most of you may know our provisioning policies, impairment policies. So significant, what is the significant level, and how should we calculate the collective impairment, and all those things will be set out here. So it is easy to operate basically. Implementation of credit policy, decision making and delegation authority, individual credit approvers, credit committee level, score based, like we have individual people approving, or we have the corporate credit committee level, several people including risk sit together and approve, or it is centralized rule based or score based approval, scorecard based approval. So like credit cards, personal loan should go for score based approval. Then we have to look at, there's another thing. With time, any facility risk increases. If you take a graph between time and the risk, when time increases, risk increases. That means 5-year loan has a higher risk than 3 months loan, right? In order to maintain the same, because we just can predict, but we can identify, evaluate the current position. In order to maintain the current risk position during the tenure of the loan, what we do, we put covenants. There are two types of covenants, positive or affirmative covenants and negative or restrictive covenants, right? Affirmative or positive covenants are covenants which can be adhered to by the borrower. Some examples like you have to maintain a current ratio of 1.2 times. You have to submit annual financial reports. You have to submit quarterly stock statement. Like that, what the customer can adhere to. Then negative or restrictive covenants are, these covenants controls the borrower. This will restrict their operation. Like, example, like if you are borrowing more than 10 million rupees per annum, you need to get approval from the bank. If you are declaring more than 50% of dividends, distributable profit as dividends, you need to get approval. Like that, you can have restriction. You can't change the auditors. You can't change the board without asking the bank. Like that, we can have restrictive. So it restricts the customer of doing something, operating. Loan covenants are to maintain the risk profile, two types, positive covenants and negative covenants. Right? These are the examples. Capital outlay, you can't invest more than 30 million without asking us. Cash dividend, this. Other side, current ratio, financials. Borrower will maintain 50 key man life. Like that, these are negative and affirmative covenants. So, we have the short lecture today. It is like this. Umbrella covering the family. It is basically our life. Credit is our life. It is almost similar to our life. So you have husband or the father who protects, then wife or the mother who nurtures, and children who plays within that protective umbrellas. Like that, we have a overreaching umbrella, which is the overall guideline given to the credit department. That is the credit policy. It covers from the origination to collecting the last rupee. All the credit related things, provisioning, CAU function, recoveries, everything is covered and directed by this. Credit policy is owned by the board of directors. Custodian is the risk department. Okay. Then credit policy increase the efficiency of working because it clears out all the ambiguities. Right. So this is credit policy. So it is a short lecture today. I just wanted to take you through credit policy. If you have any question or not clear area, I can answer you now. So basically 45 minutes earlier than normal, 5 o'clock. Any questions? Okay, if no questions, that's it for today. We will meet next week. Right? Show 29 page by please. 29, just hold on. Chatrika, this one?
Yes, sir. Yes.
Any questions from here?
No, sir. Thanks.
Okay. Right. This handouts has been uploaded. Right. Both the handouts. You please go through it. If you have any questions before starting the lecture next week, I will answer you first thing. Right. Okay. Thank you then. Stay safe.